Audio lag there. So it gives me great pleasure to bring on board Charandep Singh, founder and managing director of Girik Capital, along with him his co-founder Varun to talk about markets, their view on index investing, and where exactly are they picking spots in this market where the appetite from global investors is insatiable, but domestic institutional investors are really feeling the heat. Gentlemen, good morning. Thank you for joining us. Varun, Charandep started first last time, so let me start this time with you.
Good morning.
What is happening in the market? One side, domestic institutional investors are selling, and they're selling left, right, and center, record outflows. On the other side, foreign institutional investors are buying left, right, and center, the record inflows. So inflows and outflows both are at record high.
Good morning, Nikunj. Thank you so much for having us again. I remember one of our first conversations when we said that bull markets are born in extreme pessimism, and I think we've seen that. Last few months we've seen the phase of skepticism where it's famously known that they grow on skepticism. I think probably now we are seeing a bit of optimism. So I think that's where we are. But, for us, we don't really doubt the market. I think the biggest problem is everybody is always doubting the market. Why is it going up? Trying to find reasons that why is it going up? Not many people want to trust it, right? And we believe that if you do not trust the market, you can't be a successful investor. It's like marriage. If you don't trust your wife, how can you have a successful marriage? So I think the first point is that you got to trust the market and truly believe, and that's what we try to say in our article on index investing, that they do not try to time it, and they're always invested at all times.
Sandeep, let's take that point forward in index investing, because that's like the most popular medium of investing. I read an article on Vanguard where the assets under management, they have crossed now $1 trillion. From Buffett to a lot of money allocators are now saying that for an average investor who can count and think in terms of years and decades, they should follow a simple path of discipline and index investing. Now, index investing is something which is popular, but do you think index investing is something which already has lived its life, given that the orientation of the world is now changing very rapidly because of technology, because of COVID, and what's happening in the disruptive world?
First of all, Nikunj, thank you for having us on the show again. And yes, the article that we wrote on index investing, I can give you a very brief genesis on why we decided to write on index investing. Look, we are very big believers in the index. We're very big believers in that markets do what they do. Now, if you look at what an index really is, it's the largest market, right? So technically, the index manages unlimited amounts of money. Right? It's larger than all the large cap fund managers put together. But something that drove us to write that article was that we had a lot of complaints from people saying that, look, our mutual funds haven't really done that well in the last 5 years. Of course, there are some active managers who've healthily beaten the index, but I think it was a startling figure when we did the research that of the large cap funds, I believe not more than 8 or 10% have managed to beat the index in the last 5 years. Thus the disgruntlement amongst the investor class, because mutual funds have received a lot of money. So we decided to dig deeper, and we said, look, what's the reason for this underperformance? And, from our own experience following CanSlim and at Girik Capital, we actually believe that most fund managers and investors have cognitive biases. They have certain preconceived notions in their mind, which sometimes force them to rebalance portfolios in not a structured and thought process driven manner. So many times when a stock runs up too much, investors and fund managers will tend to take profits too early. Similarly, when a stock falls, many will average down saying, how can I be wrong? The stock's fallen. Now the index does the exact opposite. It actually will keep upweighting and increasing the weight of its winners naturally because of price increase. And it downweights its losers naturally because of price destruction. In fact, it even eliminates losers time to time. right? So stocks that were in the index 10 or 12 years ago, many aren't there today, right? So the index does churn several stocks a year. I'll give you a shining example. HDFC Bank, I was told yesterday, was something like 1.79% of the index 12 years ago. It's 11% of the index today. The Nifty index is what I'm talking about. So if you look, the index has done a superb job of consistently making sure that the weight of one of its biggest winners is at the highest point. And it's kept increasing over time, right? So the index doesn't time, the index doesn't have biases, the index is universal. It follows a very system-driven, automated process, which, according to us, every manager needs to have. So the first thing an investor needs to ask when they invest in an active manager is, what is it that the active manager does differently? Why is the active manager really charging me fees? What is it that's different from, is their process sacrosanct and robust? So we believe that most managers will, over the long term, fail to beat the index. There will be some who will beat the index. Manager selection, similar to stock selection, is a very difficult and an art that requires a process. Thus, most investors who don't have that much knowledge must stick to an index fund rather than go out finding managers who they think might beat the index.
It's a great point. I'm just going to spend some more time on this aspect, Charandep, because this is something, the importance of index investing is not very well understood, at least in India, because investors find it boring. They think that the intellectual capability is not tested, and it is always perceived that in a market like India, where in a sense you've got a lot of imbalances, you can always identify multi-baggers. So for those who want superior return, how will index investing really give them benefits of superior return? Because it's ultimately passive investing. You will never hit a multi-bagger in your portfolio if you are if you're walking on the path of index investing, Charandep.
The index actually has multi-baggers. Remember, I'm not saying that stop stock pipping and stop trying to be an active manager. I'm saying one must do that. One must build knowledge, process, discipline. Like I said, the index has a superb methodology, right? It follows processes and systems and is so disciplined that it's able to weed out its losers and add to its winners. So the index has over time got several multi-baggers, right? If you look at summers of stocks in the index, they are 100 baggers, right? What was HDFC Bank in 2008 and what is it today, right? What was TCS 20 years ago? What is it today? On the flip side, the index also makes sure it eliminates its losers. So as a fund constituent, as a construct, the discipline that an index provides you, all we are saying is something that an investor cannot ignore, which in India, we believe investors really do ignore. This is not saying, please don't pick multi-baggers. There are several smart investors in India who will beat the index. There are several fund managers who will beat the index. All we are saying is this is not easy over the long term. And investors must be realistic about their probabilities. But again, these are human biases. We as investors and fund managers tend to overestimate ourselves, overestimate our forecasting capabilities, overestimate our ability to what we believe is to beat the index and have a superior system. So this is the only point we are making.
Varun, the way index is constituted, it is a methodology. It is a methodology which requires free float, market cap and other factors. Valuation is not the basic criteria for the constitution of index. So for an investor who always keeps an eye on price is what you pay, value is what you get, index investing is not based on that.
Yeah, I think that really fascinates us, and we really feel that that is a very big factor in our style also, that it's not always about forecasting, it's not about what we perceive value may not be value. And I think that's what index does very well, because it doesn't say, okay, now I am 50p or I am 30p or this stock has become a it's much higher than its average P. It will only follow price, it will follow market cap, and it'll keep down weighting and up weighting based on that. And many times people feel that that index has included a stock very late, but that's not the truth, or it's excluded it after it's fallen a lot. I mean, if you look at stocks back in 2008, and I would talk about some of the losers which were in the index. You had BHEL, DLF, Reliance Communication, Suzlon, NTPC, Unitech. These were all a part of the index, and almost 20% of the index was these stocks. And today they're out of the index, and probably most of these stocks are down anywhere between 70 to 99%. So the point we're trying to say is that what index does very well is based on price. It eliminates its losers systematically, it downweights it, and it upweights the winners systematically regardless of the valuation, and is able to find multi-baggers. Like if you look at HDFC, what Charandep said was 1.7% of the index in 2008. Today it's 11%, and has gone up and has been a 10 bagger. And HCL Tech has been probably a 12 or 13 bagger, and Infosys has been a 6 bagger. A TCS has been a 13 or 14 bagger. This is I'm talking about in the last 10 or 12 years. In fact, a good case is something like a Kotak. A Kotak was included in 2011, and after the inclusion in the index, is almost a 7 or 8 bagger. A Bajaj Finance got included just 3 years ago. It's a 3 bagger. So the point is that even an Asian Paints is a 6 bagger after getting included in 2012. So that index does it very smartly. It brings in the leaders, eliminates the losers. And we feel that's a very, very important strategy because it keeps the biases away. And it doesn't average down. It always eliminates the loser, and it keeps adding to the winner. And it doesn't book a profit. Many people say, okay, when there is a profit, you must book, right? You must take your profit. But just think about it. If the great investors like, let's say, Rakesh Jhunjhunwala booked its Titan or Lupin, the first time it doubled, he wouldn't be the legend he is today. So the idea is to ride the winners and cut the losers.
Charandep, what is the best way to invest in the index? Time it or be disciplined like a SIP?
I think there's no exception to discipline. I think we do believe that SIPs are phenomenal ways of investing, and make sure again that you see human beings must be understood have very little ability to time. Like for example, we've been hearing, as Varun said, bull markets are born on pessimism and they grow on skepticism. We've been hearing people calling tops all around us for the last 5 or 6 months. And, we say that's a great and healthy sign. Now, if investors had done their SIPs consistently over the last 1 year, they would come out fairly ahead. And I think it's a very sensible thing not to try to time markets. Very few people have the ability to do that. I don't know a single person who in March had called that within this same calendar year or financial year, something like this would happen, right? So this is a shining example of why one should not try to time. And I think ultimately they come through. It's the right way to do it, systematic, disciplined, and be consistent. And because that's exactly what the index does. It's systematic, it's disciplined, and it's very consistent. Also, something very good for retail investors is to know that the index fund actually charges no fees. Index funds are very, very low on fees. That's another thing that helps them. So I think that these are points to be highlighted, and being systematic and SIP driven is very, very wise.
Charandep, the entry price is the very important denominator of what your future returns are. So let's say post this interaction, someone says, look, I'm going to keep it simple in my life, no tension, start index investing. It is a safe, simple and a low cost of creating wealth. Considering that if you're starting now and if you got 5 to 7 years, should one expect double-digit returns in index investing?
You see, 5 to 7 years is a very good time horizon. I think the longer your time horizon, the chances of you getting into those double digit get higher. So I can tell you that until March, nobody was in double digit, but now everybody's in double digit. So time in the market is your best friend. It's very important to have the right time horizon. As an equity investor, to understand that short-term blips will come. You could have a 30% fall tomorrow. Nobody's saying that's not possible. Keep your discipline, keep your structure alive. I've seen too many people all my life trying to time markets. Very few can do it consistently. And those that can do it, by the way, have phenomenal processes and discipline. It's not that they wake up one morning on a whim and say that, oh, you know what, the market's going to crash. So this is like kitty party and coffee conversation where, you know, people try to talk about markets being too high or too low. And, you know, in March, everybody was a bear because the world was coming to an end. Today, everybody's a bear again because it's too high. So, this doesn't work, right? Being consistent and giving it 5 to 7 years is a very base case. I think anything less than that, you shouldn't really be in equities. It's not a wise use of your time and money.
Okay. Varun, minus the index, where are you investing? Last time when we spoke to you, it was India Mart all the way.
Yeah, every time we come on your channel, it makes a new high, so you should call us more often. So last time we spoke about some of the IT names and that were coming on our screeners. And we have been invested in companies like Infosys and L&T Infotech. We are still choosing some of the larger names because we feel that the tailwind is strong. They have actually benefited from COVID. They have cut the cost. The growth is back. They are not so expensive looking at the growth they are at. And that's one place which has been up on our screener even today. So that's IT is one place. The other very interesting, what's coming up on our screener are the metal names. We've not yet managed to pull the trigger. It's a lot more difficult to understand these cyclicals, but as process, we follow our screeners, and whatever comes, we would definitely dig in and try to understand what's happening. For many years, probably a decade, people have not really made money in some of these names. So this will take a lot more time for people to realize. But that's what happens, right? That's what happens that where you don't look. Sometimes the biggest opportunity is there, and that's what our screeners do to us. So they would throw to us names which we have not looked at, and we try to eliminate our biases through this process. So we are seeing some emergence of some of these metal names. We have to dig in to know that, okay, are these for the long run or they are just a short-term phenomena?
That it's interesting that metals are coming at your screener when metal prices are at a record high. Normally people like to buy metal stocks when earnings are depressed, and when cycle starts, you benefit them. But the fact that metal stocks are coming on your screener, I have a follow-up question. Why?
No, so look, we follow a very specific process of screening based on a lot of factors, including price. So what we believe is that, even if you miss the first 100% or the first 50, 60, 70%, it's not too late. If one can do the work and understand that, okay, this is something which is very sustainable. This is something which is a trend for the next 5 to 7 years. We have seen some of these metal companies in the last cycle, if you remember, from 2003 to 2007. I mean, some of these companies became multi-baggers, like some of them actually returned probably 20, 30, 50 times in terms of the capital appreciation. So we believe that it's never too late. It's people always feel, oh, it's already gone up too much. But I feel that's just our bias. Sometimes we could find, a real value at a new high. And we always talk about that a lot of times, that, value could be found and a stock could be the cheapest it has ever been after it has rallied 100, 200%. The idea is to make that, can you understand the business well? Is it a leader? And does it have a potential to make multiple times its profits what it makes today. So that's what we would be focusing on.
Sandeep, before we wrap, are you still convinced about owning Bharti, given that price is not, they've not managed to consider a price hike, the 5G capex is around the corner. Are you in double mind, or are you convinced that we should ignore the short-term noise which is there in the telecom sector?
So there's, you see what the beauty about price is, when prices fall, people tend to question their thesis. I'll tell you, the way our system is set up is very similar. We do take notice of, price depreciation in our portfolio. When something is not performing, we tend to try to dig in and understand as to why it has not done well. Have we been wrong somewhere? So price is a leading indicator, and research is where we add value. We follow a process. We try to eliminate our biases. So when we bought something and we made a mistake, we're very open. We sit on the table and we tell one another, okay, we paid for this, we bought it, it's not worked out so far. Let's really understand why. And we take time to do this. This is not something that, oh, price has fallen 20%, take a stop loss and get out. We do tend to downweight positions that are not performing over time. Bharti, we have downweighted a little bit, and it's a smaller component of our portfolio than it was earlier. We still believe that the earnings tailwind is very much there. What can happen in the short term is when too many people chase certain stocks in the near term and they run up quickly, they can consolidate for long periods of time. Case in point could also be Reliance after such a large run up. Again, that's one of our larger holdings. We're not recommending it just as a caveat, but it's one of our larger holdings. And in the telecom space, of course, we are still convinced that the earnings tailwind is very much there, which helps us stay in our positions and our stocks. So I think that hopefully answers your question. We're going to wait and watch, and we think that the earnings super cycle is still to come. We'll give it some more time.
Gentlemen, thank you for joining us this morning. Great having you with us on ET Now, as always, with an in-depth look at some of the current factors at play and the outlook going forward.